All right, let's talk about GOSS. I know your position in Gossamer Bio has seen some, let's call it turbulence lately. So in this breakdown, we're going to slice right through all that noise and see what the facts are really telling us.
Okay, first things first. Let's not beat around the bush. Right now, as of April 5th, you're looking at a paper loss of about $1,200. And yeah, seeing red in your portfolio is never fun. But today, we're going to look beyond that number because there's a much bigger story playing out here.
So that leads us to the big question, right? The one everyone asks when a stock takes a nosedive. Is it time to hit the panic button? Well, we're going to play detective here and dig into the evidence to find a real strategic answer to that. Okay, Section 1. Let's quickly recap where your GOSS position stands and then talk about this key idea, something called a valuation disconnect. It's super important for understanding what's going on. So here are the raw numbers. You're holding 8,800 shares. Your break-even is 51 cents, and right now the stock is hovering around 37 cents. That's about a 14-cent gap per share on paper. Simple as that. These are the facts we're starting with. Now, this is absolutely crucial. This isn't a story about a company that's falling apart. What we're seeing is something experts call a valuation disconnect. Basically, it's when a company's stock price just doesn't match up with what the company is actually worth. Like, for instance, the cold, hard cash it has sitting in the bank. And that distinction, it changes everything. Okay, let's put on our detective hats. Our first clue comes from looking at the chart, the price action. We're looking for what the pros call a hard bottom.
So check this out. On March 30th, the price took a dive, down to a historic low of 32 cents. But, and this is the important part, it didn't stay there. It didn't just crash right through the floor. It bounced. And since then, it's been holding strong around 37 cents. Trust me, that's not just a random blip on the screen.
What you're looking at is a classic signal for chart watchers. When a stock bounces off a low like that and then holds a higher low, that's a huge sign. It tells you there's a floor of buyers stepping in. People who are saying, whoa, at this price, this is a steal. They're creating a solid foundation, a real floor of support for the stock.
Okay, so that's clue #1, what the market is telling us. Now for clue #2. Let's look inside the company walls. What are the insiders themselves signaling? This is a huge vote of confidence. On March 19th, management did something really telling. They took all those old employee stock options, which were priced way too high to ever be useful, and they reset them. The new target price? Just 45 cents. Now, this isn't some boring paperwork change. It's a massive, deliberate signal about what they think is achievable. I mean, think about it. Why that specific number, 45 cents? Because they believe they can get there. It's an attainable goal. What they're really doing is aligning their own employees' wallets directly with your goal, getting the stock back up towards your break-even point. Everyone is now pulling in the same direction. All right, so we've got signals from the chart and signals from the insiders. For our third and final clue, let's do what the pros do. Let's follow the big money. What's the institutional story here? Now, you might have seen this headline, I know I did. Around March 27th, news broke that looked like Vanguard, yeah, that Vanguard, had sold every single one of its shares. And your first reaction is probably, oh no, that's a massive red flag, right? Well, when you actually dig into the boring SEC filing, you find the real story. And it wasn't a sale, not at all. It was just a paperwork shuffle. An amendment called a 13G/A. All that happened was Vanguard's different internal funds started reporting their shares separately instead of all together. The shares never went anywhere, they were just put into different folders, basically. So why didn't they sell? Why are the big guys still holding on? This chart, right here, this is the whole ballgame. The company has 78 cents in cash for every single share, and yet the stock is trading for 37 cents. The big money, the smart money, they see this. They're holding on because the company's bank account is literally worth more than twice its stock price. It's just simple math.
And it's not just Vanguard's various funds either. We're talking about high-conviction funds, the ones who do incredible amounts of research before they invest, like 683 Capital and New Enterprise Associates. They haven't sold a thing. They are holding tight because they see that same undeniable cash value. So, that brings us to the final piece of the puzzle. What happens next? The company has a clear roadmap, and it all leads to a critical mission in June. This is the event, the catalyst, that's designed to wake the market up and make it see the real value here. First off, do they have the firepower to get there? Absolutely. We're talking about a cash pile of $137 million. Management has been smart. They've cut costs to protect that cash. It gives them a super long runway. We're talking well into 2027 to get this done without having to worry about money.
And here's the game plan. It's a simple 4-step mission. Step 1, conserve cash. Check, they've done that. Step 2, focus everything on one single goal, and that goal is Step 3, preparing for a make-or-break meeting with the FDA this June. That meeting is the whole enchilada. It's Step 4, the moment they hope to unlock the real value of their main drug.
Okay, so we've looked at the clues, the chart action, the insider signals, where the big money is, and the company's own game plan. So what does it all mean? What's the verdict from our investigation? Let's just run through the evidence one last time. The price action? It's showing a solid floor. The insiders? They're aiming for 45 cents. The big institutional money? They see 78 cents a share in pure cash. And the company's goal? It's all about that massive FDA meeting coming up in June.
So, all of this leads to a pretty clear strategic takeaway. Based on all this evidence, the strategy is to hold. I mean, think about it. Selling at 37 cents when the company has 78 cents a share in the bank, that's literally like giving away your cash at a 50% discount. It just doesn't make sense.
And that leaves us with this final thought. Right now, you've got two competing stories. The market, the headlines, they see risk. But the insiders, the people who know the company best, and the big money, they see value. So the question you have to ask yourself now is, based on everything we've looked at, which story does the evidence tell you?